Hello and good morning. I'm trying to reach you all through use of technology, and I'm hoping I'll still be able to make some sensible remarks about the development of bond markets in emerging economies. I'll start with a quick overview of what is the relevance of bond markets in emerging markets, particularly in context of the global financial crisis and in context of the development of corporate finance in general, and the relevance of bond markets in reducing potentially the cost of borrowings and providing investors with an alternative fixed income investment. I'll build a theoretical case about why bond markets lead to disintermediation and why disintermediation leads to lower cost. And having done that, I would take you through a quick global statistics on the extent or depth of bond markets in different countries. And while I do so, we'll anyway observe that in lots of Asian countries, the bond markets are still currently highly underdeveloped. And that allows us a scope to discuss India as a case study in the development of bond markets. India is not a shining example of a very developed bond market, but of late, certain developments have happened which could be of instructive value to a neighboring country. So let's get started straight away. And I would move to a little theoretical understanding of bond markets as to why bond markets are being talked about. I must say that post the global financial crisis, the significance of bond markets has become highly focused. All global development agencies are talking about the relevance of bond markets to global financial markets, particularly because bond markets reduce the dependence on fund-based financial intermediaries. If the existing system of banking intermediaries continues to exist, where most of the corporate funding comes through banks, that leads to a high level of leverage at the bank's level, as banks raise major resources through deposits and banks treat assets based on deposits. And that leverage during times of a crisis could result into a major shakeout in the financial system, something similar to what happened in 2007-8, aftermath of which is still continuing worldwide. In that sense, development of bond markets also admittedly reduces systematic risk, and it's with this perspective that global developmental bodies and regulators have viewed development of bond markets as a key objective. You would basically see IMF, IOSCO, or ADB, or any of the global developmental bodies currently working on a very strong agenda to provide emerging markets with stronger bond markets so as to reduce the dependence of corporate finance on banking intermediaries. And given the fact that bond markets reduce dependence on financial intermediaries, they result into more stable financial markets, and therefore they result into a global financial stability. The relevance of bond markets could also be seen from point of view of issuers and investors. As regards issuers, it presumably leads to a lower cost of funding. And as to why does bond markets result into a lower cost of funding is a fact that I'll discuss in the next slide. It also results into a diversification of investor base, as bonds are typically seen as an add-on method of funding. When I say add-on method of funding, what I mean is you anyway exploit banks as the traditional mode of funding. Having done that, as companies want to create further leverage, the companies would proceed to bond markets and try to raise funding from bond markets. Existence of bonds may also create various interesting layers in the liability profile with equity or equity-like features. For instance, instead of thinking of a plain vanilla bond, one may think of a bond with a convertible option or a bond with a contingently convertible option, which allows investors potential upside in the event the company's equity shares appreciate in value. From point of view of investors, therefore, bonds are also seen as a device to enhance yield as opposed to traditional investing in bank deposits. Bonds are supposedly attractive from point of view of yield enhancement. Bonds are more liquid because bonds are typically traded. How liquid bond markets are typically depends on secondary market liquidity. Theoretically, bonds are liquid. Practically, they may not, however, be liquid based on the extent of liquidity present in the country's secondary market. However, in any case, the existence of bond markets allows investors an alternative fixed income option. so that all the investable money does not necessarily flow into equities. Equity is good, but equity is volatile, and investors would rather like to have a cushion in form of a fixed income investing option, which bond markets typically provide. Now, investment in bonds need not necessarily go directly to companies, as mostly in most countries, bond markets typically go through intermediaries, which is mostly in form of bond funds and mutual funds. And this is what I want to show in this particular slide, which shows as to why existence of bond markets would result into more efficient cost of funding for the corporates. Now try and see the left hand side of this graph, which shows the traditional bank intermediated market. The money in the system is ultimately coming from domestic savers, call it HNIs or call it salaried individuals or call it investors. The individual investors or corporate investors, that's where money lies in the system. And in a traditional bank intermediated system, that money flows into a bank in form of so-called bank deposits. Now I'm sure you understand that bank is an entity which is regulated. A bank is required to hold a regulatory capital. The regulatory capital requirement comes in form of so-called Basel II norms. In addition, there might be liquidity requirements in form of such as a Basel III liquidity coverage ratio requirement. Since the bank holds substantial extent of regulatory capital, the providers of capital also expect returns on capital, and therefore there's a question of return on equity. Sure enough, the return on equity is higher than the cost of returns expected by the depositors, and therefore that also becomes a layer in the expected return that the bank must make in order to satisfy the objective of its shareholders. Banks also work with substantial overheads, and typical extent of overheads in any country might range anywhere between 1.5 to 3.5 or 4%. I'm not sure what is the cost of overheads or so-called uh, percentage of overhead cost for a country like Bangladesh, but I'm presuming that in most countries in the world, except for very very large banks, the cost of overheads could easily be between 1.5 to 2.5%, and that therefore becomes a layer which is ultimately passed on in form of the cost of lending to the corporates. So eventually, the money that goes from the bank or through the bank to the corporate, which borrows money from the bank, has at least three layers. There is a risk-free rate of return which is going to the savers. There is a return on equity which is being earned by shareholders of the bank. There is a cost of overhead spread which is imposed by the bank itself. There is a regulatory leakage in terms of minimum reserve requirements that banks could typically impose. It's quite commonplace for central banks of most countries to impose reserve capital requirements, which could probably be in form of investments in government securities or in form of, let's say, cash reserves. And that money is typically involving a negative carry cost, and that also leads to therefore a higher cost of borrowing to the eventual end user of money, which is the corporate. Now look at the right hand side of the graph. This is the system where the same money from the same servers is moving through a bond fund. A bond fund or mutual fund is basically an institutional intermediary which collects money by issuing typically units. Now, given the fact that a mutual fund or a bond fund is issuing units, there's no specific capital requirement as the units are not regarded as a liability. So since there is no capital requirement, there's no question of any return on capital. Mutual funds typically work with much smaller overheads than in case of banks. That overhead is typically reflected in terms of either an entry load or exit load, which in most cases would be less than something like 1%. Unlike in case of banks, there are no minimum reserve requirements. There's nothing like a statutory liquidity ratio or nothing like a cash reserve requirement in case of bond and in case of mutual funds. So even that leakage that was happening earlier in the left hand side of the graph does not happen to the right hand side. So eventually what we have is the same money is passing through a mutual fund to the corporate in form of mutual fund investing in the bonds at a cost which is significantly lower than the cost of funding through the banks. Now one might typically come back and say, well, this is not something that we see in practice, because in practice bonds issued by companies are not acquired by investors at a cost which is anyway cheaper than the cost of bank finance. This, I would say, is a question of the level of development in the country. And as bond markets become more developed, you will definitely see a lower cost of corporate funding. Something which I'll show later has actually been seen in India as well, as cost of corporate finance has actually come down as bond markets have developed. I would not spend much time on this slide as it talks about basic stuff about issuers, investors, and intermediaries. And I would therefore also skip this slide which talks about prime market, secondary market. However, I would talk about why is a bond market preferred for corporate finance by issuers. And as we have discussed earlier, bond markets result into lower cost of funding because it leads to disintermediation, and disintermediation creates a direct linkage between capital markets and the eventual user of the money, which is corporates. It also results into a lower cost of funding directly coming out of better ratings. If an issuer has a better rating, for example, a AAA rated issuer would be able to offer bonds at significantly lower spreads than a single A or double A rated issuer. Now, this automatically creates a drive in the market for achieving better ratings, and that results into overall more capital market discipline, I would say, more better corporate governance, and that results into betterment of corporate sector in general. We've also discussed earlier as to why investors prefer to invest in bond markets. They do it because they need to get a predictable stream of interest with principal payable on maturity. There's a greater safety, lesser volatility in bond markets as compared to equity. And of course, bonds are also preferred because they have much lower level of correlation with equities. And therefore, from point of view of diversification, a bond provides an excellent mixture in the wealth, investable wealth of any high net worth individual. I will take a quick peek into the state of bond markets in some emerging markets. And as we do so, we realize that the depth of bond markets, which is typically indicated in terms of the penetration basically means outstanding bonds as a percentage of GDP. It's a very, very common graphic, and I'm sure anyone who would have done any study on bond markets would have seen such graphics. This shows what's the extent of bonds outstanding as a proportion of GDP. And you can see in the left hand side we have some developed countries. The data is as of 2013, picked up from an ISCO report of 2014. And this shows that in some developed markets, the extent of bonds outstanding is even higher than GDP. For example, you can see in US and UK, approximately 125% of GDP or 139% of GDP in the UK. Now, compared to that, come to the right hand side, we talk about several in Asian markets, of which obviously South Korea is one of the most developed bond markets in the region with penetration of 87.72%. As you move down, you can see China with 45.57%. And I must say, China has achieved significant progress in terms of creating a very strong bond market over time, as the government has taken policy initiatives which have led to significant development of bond markets in that country. India is of course not a great example. As you can see, the penetration of bonds in India is just about 9.15%. And this also, I would say, the data as in this slide is 2014 data. If you were to move the clock back something like 5 years back and look at 2010 or 2009, the penetration of bond markets in India was much lower, almost like 5%. Currently, in about 2016, I would say, the penetration would be approximately in the range of about 10% or little above 10%, which is not great. However, the progress that the country has made in developing a strong bond market in the country is remarkable, as we'll be getting to see in terms of some data points, some factual points later during our discussions. We could also see that this slide talks about data and growth rates in different countries in the bond markets. I think of interest to us would be to see that in China, over the last 15-16, as you can see, there's a growth of 14% in bond markets. You can also see in India also there's a growth of 14%. I don't unfortunately have the data for Bangladesh, but to the extent I recall, the penetration was less than 1%, probably something like 0.03%. Probably in global parlance, one gets to hear only 2 or 3 issuances, that too primarily from non-financial entities. I would take you through a quick discussion, a quick inventory of different types of bonds. And understanding these different types of bonds gives us a broad perspective of the immense possibilities of structuring bonds to suit particular requirements. A bond is a very flexible instrument, and you can structure something exactly as it meets the needs of investors. From point of view of interest rate risk, one could think of a fixed rate bond or a floating rate bond. Obviously, a fixed rate bond carries a fixed coupon, and particularly in a situation of declining interest rates, it becomes a attractive proposition for investors. But for the issuer, it becomes a high cost should interest rate actually go down. Whereas from issuer's perspective, a floating rate bond passes on the interest rate risk to investors. However, from investors' perspective, this becomes less attractive. You could also see from point of view of bond the coupon payment. You could see in terms of zero coupon bond or so-called pay in kind bonds. PIK bonds or pay in kind bond actually does not pay coupon periodically. It simply reinvests the coupon, which is said to be paid in kind. You could think in terms of bonds carrying different equity infusions in form of, for example, an embedded option. Let's say an option to convert or an option to convert on happening of a certain contingency. Typically, the contingency could be achievement of a net worth trigger. If the net worth exceeds beyond a particular level, it becomes definitely attractive for the bondholder to exercise the option of conversion and get the upside by getting shares in return for the bonds. From point of view of liquidity or redeemability, bonds could be callable bonds or puttable bonds. Puttable bonds provide the option to investors to actually exit by seeking a premature redemption of the bonds. From point of view of issuer, a callable bond would exactly do the same thing, allows the investor to exit by calling and prepaying the bonds. There is a substantial bond market issuance by financial sector entities. And sorry. It would not be difficult to appreciate as to why financial sector entities make use of bonds to a very significant extent. Financial sector entities are predominantly in the business of raising money, and they could raise money either by accessing deposits, which is less preferred way for many of them. For many of them, deposit access may not be allowed at all. And in addition, financial sector entities may also be tempted to raise certain types of bonds, which will qualify as a part of a tier 1 or additional tier 1A capital or a tier 2 capital from point of view of Basel III capital requirements. So you have what is called perpetual bond, which typically would form part of a tier 2 capital, or you have an additional tier 1 bond, which is typically counted as a part of tier 1A capital, because here the payment of coupon or repayment of principal is contingent upon the bank having sufficient profits. From point of view of specific applications, you can think in terms of infrastructure bonds, where the money raised from the bonds is invested in infrastructure funding. From point of view of ratings, a very commonly talked about term is called a junk bond or HY or high yielding bond, which is normally referring to a bond which has less than BBB ratings. That's a question of whether the country in question has investors who are willing to invest in bonds with less than triple B or less than BBB ratings. So if there are such investors, there would typically be a market for junk bonds or high yielding bonds. If not, most of the bonds would be investment grade bonds. Something that I'm going to say later is that in India, for example, most of the bond issuances are BBB or above. In fact, there are some significantly much higher rated bonds such as A, AA or AAA bonds. Bonds could also be structured bonds. Now, structured bond is a generic term when we say the bond is structured to meet a particular investor demand or to meet a particular feature needed by the issuing company. Structured bonds, the overall term could also include asset-backed securities, which is outcome of a securitization process. It may also include something called covered bonds. Covered bonds or Pfandbrief, as it's called in Germany, is basically an instrument of funding mortgage lending, where the investor has a dual recourse, both against the issuer and against the collateral pool. One could also think in terms of other options of structured bonds. So I got a generic item called structured bonds. The next we talk about is green bonds. Now, green bonds is quite an interesting asset class, and of late it's quite getting increasingly popular world over. These are basically bonds where the money raised through the bond issuance goes for lending to a green project. Now, what exactly is a green project? There may not be a regulatory definition of what is green lending or green project, but as long as the project is carbon positive, the project is leading to renewable energy or leading to a saving in energy cost, the lending might qualify to be a so-called green lending. So one of the most classic examples of green lending could be lending against wind energy or lending against solar energy. So somebody who raises a green bond uses the money to lend to a renewable energy project, a solar energy project, or other forms of renewable lending. Now the question that quite often comes is, why would an investor be at all willing to dedicate or allocate his money to be invested in green bonds? What is the motive of the investor? This is clearly a case of being more responsible towards the planet. As you understand, um, energy is a huge question for the planet itself, and by investing in green bonds, you're trying to secure more safe future for the planet as a whole. We can talk in terms of sukuk bond. Now, this is a term which I'm sure I don't have to explain at length to you all. Sukuk bonds are basically Sharia compliant bonds where the bond does not carry interest. The bond does carry a right to participate in profits. Typically, there will be no overdue rate of interest. There will be a profit participation feature. And the money raised by issuance of sukuk bonds could also go in Sharia compliant lending only. Bonds may also be classified in terms of credit enhancement. Now, what we mean by credit enhancement is the issuer trying to jack up the rating of the bond by using some external or structural credit support. For example, a partial guarantee could be one such option. A partial guarantee is one structure which is quite commonly recommended by even multilateral developmental bodies. A partial guarantee provides the bond investor with a guarantee of a certain part of principal invested. For instance, if the investor gets a guarantee of, let's say, 20% of the principal amount from a bond guarantor, the issuer takes the first loss risk anyway. The risk of the first 80% is there on the issuer anyway. And if at all a loss should occur and the investor should suffer a default of up to 20%, the investor could get compensated from the bond, from the guarantor. So there is no complete guarantee as such. A complete guarantee would be unworkable in terms of costs. A partial guarantee for at least a part of the principal invested by the investor. We'll take a quick look at the developments in some of the Asian countries. Indonesia, for example, has drafted a government bond issuance plan for 2017 for an amount equal to rupees 155 trillion to be raised in the first quarter itself. Monetary Authority of Singapore announced an Asian bond grant scheme which allows grant to the first time Asian companies or non-banking financial intermediaries who intends to list bonds in Singapore Exchange to offset 50% of one-time issuance cost. This is basically a device to attract issuers to come to Singapore and issue their bonds here. South Korea is one of the most developed bond markets in the country, in this part of the region, and South Korea has basically implemented crowdfunding rules which were implemented in 2016. And I'm sure you all understand crowdfunding is something which allows so-called peers or so-called individual investors to come to join the money together and to invest in bonds through a crowdfunding platform. China as a country has taken lots of significant steps in terms of regulatory impetus to the bond markets. And in 2016, China became the first country in the world to pass a green bond legislation. As you would recall, sometime back we talked about relevance of green bonds. So China is probably the only country in the world which has a green bond legislation. In addition, China has been encouraging issuance of so-called panda bonds or dim sum bonds. Panda bonds basically are renminbi denominated bonds issued in offshore markets, and dim sum bonds likewise are foreign currency denominated bonds issued overseas. We turn to the state of bond markets in India, and that allows us to focus on what this country, a neighboring country, has done in the recent past in terms of development of bond markets and the impact that such development effort has had on the cost of funding for corporates. And I have some very significant points to make as we discuss this. Let me first start by saying that, as in many Southeast Asian countries, India is also a highly regulated market with multiple regulators whose regulations might impact issuance of bonds. On the slide, you can see several regulators: the Ministry of Corporate Affairs, which regulates companies; the securities regulator, which is Securities Exchange Board of India; the central bank of the country, Reserve Bank of India; insurance regulator, provided insurance companies want investing in the bonds; likewise If it's a pension fund or employee benefit fund investing in bonds, then the Pension Fund Regulatory Development Authority. Now, what these regulations over a period of time have done is to, in the past they were acting so as to stifle, so as to demote the development of bond markets. But lately, through positive regulatory moves, they were trying to develop the bond markets in the country. One very notable feature of the Indian market, as you could probably see in the very first slide here, is that assets under management of mutual funds have grown to INR 18 trillion, and 7.5% growth was there in the first 3 months of um, calendar year 2017. Expectations are that assets under management will cross 20 trillion rupees during the year. Now, this is a massive money, and approximately two-thirds of this money is dedicated for investments in debt securities. Why am I trying to make this point? This point is very significant. As you would all appreciate that talking about development of bond markets does not have much relevance unless you also simultaneously develop capital market institutions. Development of debt funds and development of bond markets will have to go simultaneously. There is no way to look at development of bond markets without developing institutional investors which will develop in such bonds, which will invest in such bonds, and that would predominantly include debt funds, insurance companies, pension funds, and the like. So regulators have to create an enabling and congenial atmosphere whereby more and more money could flow into investments through debt market institutions, which in turn could take stakes in bond markets. So even in India, for example, money is coming into bond markets not directly, in most cases not directly from investors. Money is coming through bond funds. Approximately, as I mentioned above, approximately about 12 trillion rupees are flowing through the mutual funds into the bond markets. The Indian market is mostly a private placement market. If somebody thought somebody issuing a bond must be making a public issue, and public issue is like issuing bonds to retail investors, that's mostly not the case in India. While bonds are issued privately, the bonds are taken to listing, they are still listed, so there are listed privately placed bonds. Most of the issuance in India is from financial sector entities, and this is actually a kind of aberration. I wouldn't appreciate this feature because actually one should have more bond issuances coming from non-financial entities. But in India, for some strange reason, primarily because of regulatory problems, issuance has in the past been restricted mostly to banks and non-banking financial companies. Most of the bonds in India are secured bonds, whereas globally most of the bonds are unsecured bonds. Most of the investors in India prefer to invest in higher rated bonds. You'll find most of the issuances are either AA or AAA variety. There are very few single A's, and there are even fewer triple B's in the market. Also, we note that substantial extent of FII funding, foreign institutional investor funding, has gone into corporate bonds, and approximately 2 trillion rupees have gone from FIIs in investing in bonds. I was talking about several steps taken by regulators in the recent past to develop the bond markets, and I will talk about some of these which could be quite significant. Number one, it's possible to do a listed bond issuance even without going for a public offer. Now, one would normally expect a public offer leading to listing, but in case of bonds, it's possible to do a private placement and yet get the bond listed. Why would one get a privately placed bond listed? Well, that's obviously for the purpose of liquidity, for the purpose of price discovery, and regulations in India allow privately placed bonds to be listed. There is also a possibility of private placement of bonds by non-banking financial companies. So the regulators permit non-banking financial companies also to access the bond markets. There are two important pieces of legislation which have recently been passed to allow recovery rights to bond investors. One is an enactment called Securitization and Reconstruction of Financial Assets and Enforcement of Security Interests Act, a long title which is typically abbreviated as the so-called SARFAESI Act. The SARFAESI Act actually does what? It allows a creditor to exercise or enforce security interest backing up a loan or backing up a financial asset without the intervention of a court. If there is a loan which is defaulted and there is an asset backing up the loan, one could repossess the asset without approaching the court. Until 2016, This option of non-judicial enforcement of security interests was not applicable to bond investors. 2016 amendments allowed this option to go to bond investors as well through the device of trustees. Yet another important legislative measure is the enactment of Insolvency and Bankruptcy Code. This is by itself a landmark legislation which sets a very stiff timeline of 6 months for resolution of defaulting entities. If defaults are not cured by way of a creditor's approved resolution plan within 6 months' time, the entity will mandatorily go into liquidation, and in liquidation, of course, the assets will get distributed to different investors based on priorities. The Indian market so far was a highly regulated market. The market still continues to be partly regulated, but of late, several relaxations have been granted to regulations to enable more bond issuances to come. So, one of the notable features of regulatory relaxations given in the recent past is the option for a non-banking, non-financial company, a non-financial entity, to come up with an unsecured bond. Now, as I mentioned sometime earlier, globally most of the bonds are unsecured bonds, and it was because of regulatory reasons that in India most of the bonds were secured bonds. But this anomaly is now hopefully getting corrected with regulations permitting unsecured bonds to be issued by non-financial entities. There's also a requirement for so-called debenture redemption. This is applicable particularly in case of public issues. It's not so much applicable in case of private placements. Now, let me quickly take you through the slew of measures taken in the recent past to popularize bonds, and I'll talk about some of these at some length. I'll maximum take another 5 minutes to finish this. So, number one, partial credit enhancement. Banks are now been permitted to provide partial credit enhancement in case of bond issuances by corporates. So, if a company wants to come up with a bond issuance and the company approaches a bank to give a partial guarantee, the bank, for example, takes let's say 20% guarantee, that would mean investors facing a loss of up to 20%, they would recover the money from the bank. If the investors face a loss of more than 20%, of course the investors write the loss. Their first claim is on the bond issuer. Should the bond issuer fail to repay the bond obligation, and the investor exercises his interest on the underlying collateral, the security interest, ultimately they are able to recover, for example, let's say only up to 80% of the money. The balance 20% they can claim from the guaranteed bank. I'll be talking at some length about masala bond, which is a very interesting instrument. I'll just talk about that later. I must also say that investments by foreign portfolio investors were encouraged, and for this purpose, even enabling provisions were enacted in the taxation laws. Now, why is taxation law important here? As I'm sure you understand, India has a withholding tax. Most countries actually have withholding taxes on payment of interest to cross-border investors. Taxation law in India provides that there is a uniform 5% withholding tax on investments put in by foreign institutional investors registered with the securities regulator. Now, from point of view of any global investor, a 5% withholding tax is quite reasonable, as the investor suffers only 5% tax, rest of the money he takes back home after suffering 5% withholding tax. I must also spend 1 minute talking about the last bullet in this slide, which talks about placement of debt securities through electronic book building mechanism. Now, typically when companies go for a private placement of bonds, the pricing of the bond, the placement of the bond could be extremely opaque, could be non-transparent, because the company does this privately. Investors are approached privately, investors make bids privately. Nobody gets to see who is participating in the bond issuance and how is the price discovered. Now, recently the securities regulator provided that for any bond issuance of a large size, rupees 500 crores or above, the placement will have to be done through an electronic book building mechanism, which would mean bids will be placed on electronic platform. So the bids will be transparent to everyone. Everyone can see who are participating, and subject to restrictions, one can participate in the bond issuance as well. I'll be now rushing to finish my presentation, so I'll quickly first say, as I mentioned earlier, the larger part of the bond issuance in India is still private placement. Public issue is not that large. So this is the data talking about public issue of corporate bonds, and the next slide talks about private placement. As you club public offers and private placements together, you can see over the last 4 years, there's a sharp increase in the total value of bonds from 2013-14 at 48.5 billion US dollars to something like 103 billion US dollars in 2016-17. This is almost like 120% growth, and this is really remarkable growth. As the extent of corporate bonds or reliance on corporate bonds has gone up on the part of financial institutions, you could see this slide says something very important. As the percentage of financing through bonds has increased, which is the green line shown in the graph, you can see the red line which is sliding down. This red line actually is the cost of funding, and as you can see, the weighted average cost of funding for companies has actually come down as the extent of dependence on corporate bonds has increased. This is clearly proving the hypothesis with which we started when we started off this presentation, that vigorous use of bonds by companies actually tends to bring down the cost of funding. And this is not clearly seen in case of non-financial institutions. As I mentioned earlier, in India, most of the issuances come from financial sector and not from non-financial entities. These slides talk about non-financial entities. Last 1 minute of my presentation, I'll talk about a unique instrument which was tried just about 2 years back. It has become immensely popular lately, called masala bonds. The word masala bond, masala stands for spices, as you understand. The word was used for the first time by IFC when IFC issued a rupee denominated bond in London Exchange in November 2014. For whatever reason, IFC called it masala. Masala curries are particularly popular in the UK. So these bonds were called masala bonds. These are basically rupee denominated bonds issued in international financial markets. One would normally expect an Indian issuer raising money from global markets issuing the bonds in dollars or euros. But this one is a typical case of an Indian issuer raising money from global markets, however, issuing the bonds in rupees. Now, which actually means what? The investor takes the risk of the currency. As regards the issuer has denominated the bond in local currency. So it's a local currency issuance, but issued outside the jurisdiction. And this particular masala bond has become extremely popular. You can see that regulatory policies have actually tried to promote the use of masala bonds, and that actually has worked. Reserve Bank of India first committed through changes in external commercial borrowing rules in April 2015 to allow Indian companies, Indian financial entities also to issue bonds globally in INR denomination. Subsequently, the Reserve Bank of India also allowed banks to issue Tier 1A or Tier 2 capital bonds also in global markets denominated in Indian rupees. Withholding tax was reduced retrospectively to 5%. I had earlier mentioned there was a 5% withholding tax in case of FIIs. This was actually applicable to straight bonds, not to masala bonds. But retrospective amendments were done in tax law to allow the relaxed rate of 5% in case of masala bonds as well. And as a combined result of each of all of these measures, there has been a significant move towards issuing masala bonds in the country. As you could see in 2016-17 last quarter, as much as 39% of the total external commercial borrowings in India came by way of issuance of masala bonds. Masala bonds have now been issued by leading housing finance companies, leading non-banking finance companies, leading power sector entities, leading telecommunication entities, and so on. So there is a complete rush to either London Exchange or the Singapore Exchange to go and do a masala bond issuance. And reports suggest that leading issuers are able to reduce their cost of borrowing by as much as 150 basis points. 150 basis points or 1.5% reduction in cost of funding in today's terms, where the cost is approximately 9% in global markets, is quite a remarkable achievement. And this is, I would say, an appreciable case where regulatory initiatives coupled with just appropriate market scenario where rupee is going strong, rupee is going stable, international investors have expressed interest in investing in the country. All this combined together have resulted into a very, very positive development for the country in form of huge amount of money coming into the country. Thank you very much for your attention. Thanks.